There we go.
We're in business.
All right. All right. So thank you all again for joining us this afternoon. My name is Steve Oakes. I'm the owner of Save Your Profits, and I'm here at the Pueblo Latino Chamber of Commerce. Wanted to share some information about employee retention credits and employee retention tax credits and how they could impact your business and actually be a source of some substantial capital to help your business grow if you either started a business during the pandemic or if your business was able to survive the pandemic with W-2 employees intact. So I myself am a member of the BNI Abundance Builders chapter, and the Abundance Builders is a business networking group that is a member of the Latino Chamber. The Abundance Builders is just one chapter of about 300,000 members across the world. We're in 6 continents because nobody is actually in Antarctica. But we are, last month, we had about $400,000 worth of closed referral business to BNI members. And this, a week from Tuesday on September 20th, we're going to be having an Visitors Day and inviting all local businesses to come and see, guests are waiting in the lobby. All right. Oh, we've got teams coming up too. But we'll have a Visitors Day on September 20th at 7:30. We meet every Tuesday morning at the YMCA on Spalding off of Pueblo Boulevard. And if you'd like to grow your business, we are looking for additional members. We are an exclusive marketing and referral business or chapter. And so we have one member of any business category, and all of our referrals and prospective businesses or prospective business and referrals go to those businesses in those categories. So if you would like an introduction, I'd be more than happy to have you join us next Tuesday on the 20th. All right, so let me tell you a little bit about myself. And I'm Steve Oakes. I'm the owner of Save Your Profits here in Pueblo. And we are an expense reduction and profit recovery experts. We audit financial categories and reports from nearly 50 different categories of expenses for businesses. And then we also work to bring money back to a business that maybe has overspent or paid some of their profits that they didn't need to. So we help to recover that. So I am a Pueblo native and here to Pueblo, and we are a success-based business model, which means that we only get paid when we actually can show measurable savings for our client or when we return financial benefit back to that client. Our teams of analysts each has over 20 years of experience in their specific expense category. And we do over 50 different categories of audits. To date, we have done over 25,000 reviews and saved our clients over $1 billion. Our expense reduction analyst service is provided at no risk. There is no upfront cost. We only get compensated when our clients receive actual measurable savings. We're committed to our clients' passions, and we demonstrate this by donating a portion of our fees to a charitable organization, foundation, social project, or nonprofit of our client's choice in our client's name, for example. Our work could also assist in helping to make those charities stronger by either providing additional funding or subsidizing any current obligation to vendors or corporate supporters that have committed to. Higher profits for a higher service is our motto. And in the last 10 years, we've donated more than $50 million to these causes and hope to double that in the next 5 years as we continue to grow our business and our clients' businesses. I am also a certified expense reduction consultant by the International Association of Expense Reduction Specialists. We are not financial advisors. I'm not a tax attorney, insurance broker, or any other regulated licensed profession. Please consult your own advisors on any of the contents in here if you have any questions. And thank you very much. So let's kind of get started. So everybody remembers what happened when the pandemic hit, right? There were lockdowns, there were shutdowns, stay-at-home orders, and most everybody across the country, if not the world, for some time, shut their doors. Now, as quickly as possible, some industries were declared essential workers, which meant that these are businesses that have to keep open to allow people to live their everyday life and to move forward. Things like grocery stores and hardware stores, construction services, home services, those were considered essential, and at some point even given permits to travel, which was unique to the history of our country. Then everybody else was kind of considered non-essential. And at that point, there were other ways that the government wanted to help people that they forced to close their doors. These are small businesses to large businesses. A couple of different methods that they had were PPP loans. These were kind of a first come, first served loan conducted through normally your commercial bank, and they would do the paperwork and such for to secure these possibly forgiven SBA loans. There was limited funding set forth by Congress, and there were 2 rounds of that funding that were available. Depending upon how you used the money that they did provide you to those businesses, as long as it was used for employees and for essential business, then you were able to have that loan forgiven. And it was basically for just about any size business, as long as you had employees, even contractors that were self-employed LLCs could get that financing if they were able to make the connections through the banks. Another form of recovery money that they made available was called an employee retention tax credit or employee retention credit. So that's where we see ERC and ERTC. These were limited to small employers, though, and originally in 2020, these were limited to only businesses with 100 or less employees. And that was the 2 ways of funding that primarily people had during the pandemic. So what is an ERC or ERTC? So the Employee Retention Tax Credit is a fully refundable payroll tax credit for qualified wages paid to employers who retained their W-2 employees. It is actually available for up to $26,000 per W-2 employee for the wages that were paid from March of 20 through Q4 of 2021. A tax credit was one that you could do if you were filing for these funds while you were in the midst of the pandemic. Afterwards, once that time period closed, if you file afterwards, it basically becomes a tax refund for the overpaid taxes that you may have submitted to the IRS. There are different rules if you are a startup recovery business, a business that began after March of 2020 versus a business that was already formed when the pandemic hit. And we'll be able to talk a little bit about both of those. Now, the Employee Retention Credit was passed into law as part of the CARES Act in 2020. The credit was extended all the way to December of 2020 in that original package. And then the Taxpayer Certainty and Disaster Tax Relief Act of 2020 actually allowed businesses or employers to go back and receive both ERC and PPP loans. In the original CARES Act, if you got a PPP loan, you were not eligible for the ERCs. They didn't want people double dipping. In other words, if I give you a PPP loan to pay your employees, I'm not going to give you a tax credit for the money I gave you. So they made those exclusive. But later in one of the 4 major revisions of the changes to ERCs, they removed that. The American Rescue Plan Act made the ERCs available throughout all of 2021. So we actually extended that from 2020 all the way to the end of 2021. And then the Infrastructure and Investment Act at the end of 21 came back and said, well, we're going to spend some of that money on infrastructure needs. And so instead, we're going to take that fourth quarter away. So it pulled back some of the funds by a full quarter, saving millions and millions of dollars for the government, but not necessarily for the local and small businesses. And here's some primary differences that happened and how the 2020 ERC versus a 2021 ERC changed. It was based on W-2 employees and their qualified wages. It's eligible for businesses that experienced either a full or partial suspension of their operations or had a significant decline in gross receipts. And that's a big conjunctive there. It's or. It is not both. So your qualified wages included your general wages paid, as well as any health plan expenses and pension funds through 2020. During 2020, the employee the employer could recover up to $5,000 per employee, and that is if they had 100 full-time employee or equivalent employees or less. And then if you had a PPP loan, it made you ineligible for those ERC credits. In 2021, some of the changes that happened in the Appropriations Act, it raised the limit of up to 500 full-time equivalent employees. It also extended through the Q4 of 21, $7,000 per quarter instead of the $5,000 for the year, which made a max of 28. And the ERC was changed from a credit against the Medicare tax to the credit against Social Security taxes. In 21, they also added that startup recovery business because they saw a lot of new businesses forming that needed to have some help. And by taking people off of unemployment or continuing to pay people for W-2, that's pretty much what the recovery was for. It's kind of a reward for doing that. However, at the end of 21, the Infrastructure Act removed funding for Q4. So this is kind of how that works. So the big takeaways here is that a maximum credit for your W-2 employees for all of 2020 was up to 50% of the first $10,000 of wages, which would be the $5,000 max. And in 21, they changed it up again up to a high level of 500 full-time employee, equivalent employees, and then 70% of the first 10,000 wages per quarter. So that gave you $7,000 per quarter. With only 3 quarters after the last change, that makes a maximum of $26,000 per employee for that for the recovery. So how do we know if your business qualifies for that amount or for a portion of that? Well, there's a few primary qualifiers that make you eligible to file for this recovery. These qualifiers are qualifiers. They are not disqualifiers, meaning that if you meet one of those standards, then you are qualified. You do not have to meet all of the standards. So did your business experience a reduction in revenue? And this is normally a significant reduction of revenue. You would need, comparing quarter per quarter from 2019 through the 2020 quarters, about a 50% reduction in gross receipts. And then comparing 2021, it's a 20% reduction to get you to that point of the prior quarter in the same year. The other way that you could do that is your operations were restricted by some kind of policy, and they define it as a nominal business impact. So were there restrictions that forced you to close your doors for a period of time? Did it limit the number of people that could be in your business? Did it limit how close your own employees could be side by side, like in an assembly line, and remove the productivity? Did you have to pay for a third party to deliver food, for example. What kind of impacts that were in place because of a government policy or restriction, and how did that impact your business? Now, the operations of your trade or business are fully or partially suspended during the calendar year or quarter per quarter due to orders of that appropriate government authority, and limiting the commerce, the travel, or group meetings, for example, commercial meetings, social or religious meetings, or other purposes due to COVID-19. When was your business impacted because your clients' restrictions prohibited normal business? So that's another way that it could happen. So it might be that you weren't able to go to your client's location. If their building was closed and you do your service at their business, then that's a way that qualifies as a limitation. Physical distancing, 10% more of your business operations or services were limited because of those suspension is qualified as a nominal business impact. And one of the other ways was your business impacted because it was unable to procure those critical goods or materials because of supply chain issues? So was your vendor shut down and you weren't able to get those parts? Do you normally get components from overseas, and because everybody was shut down and the supply chain issues, you weren't able to get equipment? So that's another way that we can show those restrictions in place and impacting your business. Some examples of those qualified restrictions: replacement parts weren't available, sales reps were not able to go and visit their vendors, inventory was stuck on ships at ports, non-elective procedures were restricted, and so medical facilities weren't able to continue in their normal mode of business. Manufacturers weren't able to get raw materials in a timely manner, and that was a continuing supply chain impact. Children weren't available to go to schools. Daycare was unable to serve their clientele. Pharmacists were impacted because of those same hospital regulations. Hairstylists and barbers were unable to provide their services. And moving companies not being allowed into to homes, cleaners not be allowed into business. Restaurants were heavily impacted by all of the restrictions. Hard to find a category or industry that was more harshly impacted than restaurants. And then, contractors had to cancel jobs or because of delays in product and capacity, and couldn't get the raw materials. So what are some of the other questions about qualifying for these? So the questions that we would normally find out would be, how many W-2 employees did you retain? And we are talking about W-2 employees versus 1099 contractors. When we're looking at that total number, one of the rules for employee retention credits are that ownership and direct relations of anybody with 20% or more ownership in the business, their wages are not included in the calculations. One of the things that we'll ask is, did you get either a 1 or 2 of the PPP loans? Whether or not you got a PPP loan in itself is not going to qualify. In fact, even if you got PPP loans and it was forgiven, does not mean that you don't qualify for that up to $26,000 in recovery. It's just a portion of the calculation that we use to look at that. Maybe when did you open or when did you buy the business? So there are different restrictions depending upon whether the business was acquired or merged, and how that plays out. Or did you actually start your business after the pandemic closures began? So if it was after middle of March, there are different rules that you qualify for and different amounts. So just because you're a startup business, if you started out by hiring W-2 employees and taking people off of the unemployment rolls, the government has some rewards possible for you. The other option is maybe you already sold your business or you closed the business because of the pandemic. If you paid those payroll wages and taxes during a portion or through the end of that Q3, then you may have overpaid those payroll taxes, which means that you could get that recovery back as well. So those are some important questions that we often get asked and what we look at when we're trying to check eligibility. We've had a number of people say, well, I was told that I don't qualify. People have come to us, and we've literally taken people that said, no, my accountant said I made too much money. Well, remember that a reduction in revenue is only one way to qualify. You don't have to hit all three of the primary qualifying opportunities. You only have to qualify in one way to be eligible for these. So one example, we worked with a trade association that had about 18 employees. They did have a forgiven PPP loan, but we were still able to recover almost or over $400,000 for that employer, for that association. A restaurant with about 19 employees qualified for nearly $60,000. Comparatively, a restaurant with about 41 employees, they did receive a PPP that was forgiven. And our team determined that they qualified for near over $400,000 as well. We've also worked with a nonprofit that received a PPP loan and was forgiven. This nonprofit actually receives funding from the government as well for their payroll, and they still got a recovery of just under $800,000. So a lot of people say, I was told I made too much money. We keep working, even though we kept working as usual, the restrictions didn't impact us that much, but there were restrictions in place. There also, most of my employees are part-time, not full-time equivalent. We take all of that into account when we're looking at the calculations to get the maximum amount of retention credits returned to you. And then we've even had quite a bit of success with nonprofits. And a lot of times what we'll hear is that as a nonprofit, I can't get money back. Number one, I did have my employees, but I don't know what the impact was. But number two, it looks bad for our donors. On the other hand, look at what a great opportunity is to improve your community that you serve as a nonprofit by getting this money back and being able to reinvest that in capital projects or in expansion of your reach for the community that you serve. Now, if any of these restrictions type things were in place, you may still qualify, but you need to review that with our expert team of CPAs, our tax preparers, and our tax attorneys to validate that. And these are, again, qualifiers, not disqualifiers. So just because one piece doesn't match what your business experienced doesn't mean that the others can't step in for you. So let's look at a couple of success stories that we've had. A number of these, if not most of these, are actually from the Southern Colorado region that I've personally worked with and helped out. So we had a small taco restaurant of about 9 employees. They're expecting their refund of about $34,000. We actually worked with an accounting and tax firm who understood that this is really complicated and didn't necessarily want it to be in place where if an audit were to come in the future, that they would be willing to go to the tax courts and defend the calculations. So for those 7 employees, that owner received about $44,000. We worked with a startup juice bar. This is a juice bar that ended up with 3 locations by the end of Q4 because startups have an extra quarter to qualify. And they're actually getting a refund of about $150,000 for their business. There's an entertainment venue here with a bar, about 51 employees, and all encompassing, we had about $165,000 coming back to them. I've worked with a nonprofit right here in Southern Colorado that has about 15 employees, and we're waiting now for their refund for almost $200,000. And a cannabis glassware and paraphernalia store had about 32 employees, and we're expecting to see a refund of over $350,000 for them. A local food franchise with 150 employees, over $350,000. Another nonprofit right in this area with over 200 employees is waiting for the IRS to return $1.7 million to their nonprofit. Think of the reach and the breadth of that they're going to be able to share with all of their community and outreach that they'll be able to do with that additional money and funds coming back. And then a food franchise that's based here in Southern Colorado had about 350 employees across all of its sites, and they are getting nearly $3 million back in their recovery. On average, our average ERC client enjoys a recovery of about $600,000, or on average around $5,500 per employee across all of the industries that we've worked with so far. So those numbers kind of fluctuate. Of course, a lower wage is going to impact the recovery versus an office of attorneys versus a food establishment that might have more minimum wage or minimum wage plus tip employees. So there's a wide variance there. Let's look at potential clients, people that we can help or have even helped in the past. Restaurants, as I said, no industry was nearly impacted as much as restaurants outside of churches, synagogues, and other religious organizations. Nonprofit organizations, private schools, entertainment venues, retailers who had to shut their door, limit the number of people that could come in to shop and relied on that business for their income were impacted, as well as the trades not being able to go to a client, whether that was a residential or commercial client because of those restrictions, not being able to get the materials to perform their jobs, having to separate crew members because they weren't allowed to be in the same truck at the same time. All of these are great industries that we're able to help and qualify. Another opportunity, or how do we find out? Again, did you get a PPP loan? If so, was it forgiven? This is only used to help us with the calculations and to see what kind of recovery we may be able to help you with. Government restrictions on your business, government restrictions on your client or your vendor's business, and then the loss of revenue, somewhere between 50 or 20%, depending upon quarter per quarter of gross revenue loss. Also, if your business was a startup after March of 2020, or did you close your pandemic during the did you close your business during the pandemic? So what makes Save Your Profits different? We are a success-based model, so there is no risk. There are no upfront fees. We don't collect any money until you actually receive a refund, in this case, from the IRS. Until you get that check back, you don't owe us anything. We're going to work ahead of the curve, and we're going to do all the work up front. And take care of that. 90% of the time, if we're working on our expense reduction or profit recovery, 90% of the time we maintain the same vendor that our client has been working with all along. So those relationships that you built are maintained. We just make it a better relationship. And as always, a portion of our fees are donated to whatever passion cause our client or their employees support. So we've donated over $50 million in the last 10 years. And then one strategy that we never use to help reduce your expenses is that of workforce reduction. We are not about taking this team and going from 5 to 4. That's not part of our strategy at all. Lastly, I guess I can say that pretty much covers the most of that. Just a couple of pieces real quick. We've seen, even though we've helped some of our clients that we've had before the pandemic file for these employee retention tax credits during the pandemic. So that money never even came out of their pocket. There's similar projects where regions that are impacted by tornadoes or hurricanes or some other natural disaster, where the government will have a program to help keep those people, those employers, paying their employees rather than put them on unemployment rolls. And our team has worked with them in the past as well. So this has just been an extension of what we've done from that. We've seen a lot of pop-up ERC type businesses. Somebody with a calculator who says, oh, I can crunch your numbers and do that. However, built into the fees that we have is included representation in the case that one of the 88,000 new IRS employees happens to pick your business and wants to do an audit of how we came up with that. So our team is there to represent you in the future for any cause or case that may be brought up because of the calculations and the work that we've done. I've also helped one of the nonprofits, just a quick story. One nonprofit I worked with had already given their financial information to one of these email companies or phone call companies that have been reaching out to small businesses. They gave them all their information and then got a result back and a contract and a power of attorney so that they could follow along with the return. When we looked at the power of attorney, however, that company was taking that IRS refund check and had rerouted it to their company and claimed that that would be given to them. They would take their fees, and then the money would go to the remaining fees, funds would go back to that company. With today's red flags and scams and who's on the other end of a phone call, it's really tough to just hand over this kind of sum of money and your business information to some other company. Whereas, I think that we have shown with over $10 million of recovery through myself, 2 million of that going to nonprofits here in the Southern Colorado, without counting the amount that we're donating. I hope that we've earned a bit of trust, credibility, and we're very transparent as far as a company working. So just to move on from there, here's some information. If you'd like to talk more, get some information about employee retention credits, if you'd like to talk about how we can save your business money with a vendor that you're using, whether we're talking about things like fleet management, medical or lab supplies, payroll expenses. We cover 50 different categories to help most businesses, find a way to help save some money. Another quick thing that we do is college tuition assistance. So not only do we save your profits, but we help save your tuition. We are a part of a team that looks at the FAFSA applications for you. We can look at how your finances are set up as business owners or individuals. And what we do is maximize the amount of assistance that we can get for college tuition so that you have to have the least amount of loans or out-of-pocket expense. We also provide incentive programs for businesses that are expanding into new cities or states by working with those local governments and development organizations to secure tax credits, training funds, and other ways to make it easier and more profitable to start up in a new area as well. And again, in general, we have 50 different categories plus that we work in expense reduction. So let me just check real quick and see if we have any live questions. Okay, so one question that came up was, if you received a PPP, your business would not qualify. And that is opposite. Just because you received a PPP does not disqualify your business. Originally, in the 2020 revision of all the rules, it did. But in 2021, the legislation came back and said no, because PPP loans could be used for employee wages, but it could also be used for any business essential expense. So maybe you had to pay your lease, maybe you had to pay your workers' comp. You could use it for business remodeling, for deferred maintenance that you had been waiting until there were, unfortunately, no clients in the establishment. So they understood that there were other ways to use PPP money. It was not specifically for payroll, even though it was in the name. So just because you got a PPP loan does not disqualify you, but it does not qualify you. It just means that we have to use the amount that you got in the calculations to determine how much of an employee retention credit you would get back. All right, I'll give just a couple minutes. If anybody else online has another question.
I have one question.
Nope. All right, we've got a question in-house.
Yeah, so that money that comes back to these businesses, is that money liquid for them? Can they use it as they want, or does that money go back directly into their employees?
Great question. So when you do get a recovery and you get the funds back from the IRS, are there any restrictions on those funds? And the answer is no, there are no restrictions on that. You can use it for capital expense. You can use it to pay bonuses to hire new employees. You can use it for bonuses for people that stayed with you. Depending upon the amount and the circumstance of your specific business, however, it is possible that the recovery that you get for 2020 will have to go back and readjust your income statements and taxes for 2020. And the quarters of 21 that come back to your business, you may have to refile and adjust your income statement. So even though you're recovering money that you paid for taxes, of money that you had to pay your employees, when you get the refund, the IRS is in some cases still considering that to be taxable income. So you may have to pay taxes on that, but there's no restrictions on how to spend that money once you get it back. It's a good question. All right, I'm not seeing any other questions. However, of course, if you have any questions, my contact information is here. Feel free to scan the QR code, and that will take you to my contact and calendar. And feel free to book an appointment, and I'd be happy to either in person or Zoom or phone discuss some more details with you on your specific business needs. More than happy. Lastly, I just want to say thank you to the Latino Chamber of Commerce here in Pueblo and everybody who joined in person, as well as those who are watching this on a replay. If just as a way to express that even more, because we are looking at higher profits for higher purposes, and the Latino Chamber is a great nonprofit here to help out businesses that survived and got through the pandemic and are growing afterwards. If you mention that you saw this presentation when you discuss your company's opportunity with us at Savor Profits, then we are going to make an additional donation out of our fees to the Latino Chamber. And that is in addition to whatever passion project your organization has. So we're going to go ahead and make our normal donation, but we just want to thank the Latino Chamber for the opportunity to share that with all the local businesses here in Pueblo, all of their members, and throughout Southern Colorado. So if there are no more questions, again, I want to just thank everybody for joining us today. Hope you found it educational. Please reach out if you have individual questions, and we'd be more than happy to share what we can.